Question 131. The contract of sale is also called each of the following, except a. An agreement of sale. B. Installment sales contract. C. Unconditional sales contract. D. Conditional sales contract. Correct answer is C. Unconditional sales contract. Contract of sale. This is a broad term for an agreement where a seller agrees to transfer property to a buyer for a price. A. Agreement of sale. This is a common synonym for a contract of sale. B. Installment sales contract. This is a type of contract of sale where the buyer pays for the property in installments over time, and the seller retains title until the final payment is made. This is a form of conditional sales contract. D. Conditional sales contract. This is a contract where the transfer of ownership is contingent on certain conditions being met, like full payment. A land contract or installment sales contract is a type of conditional sales contract. C. Unconditional sales contract. This is generally not used. Most real estate sales contracts have conditions. Therefore, unconditional sales contract is the term that doesn't fit with the others. Question 132. Convertible adjustable rate mortgages, ARMs, can be modified into a fixed rate loan. B. Short-term loan. C. ARMs cannot be modified. D. None of the above. Correct answer is A. Fixed rate loan. ARMs are a type of adjustable rate mortgage that gives the borrower the option to convert the loan to a fixed rate mortgage at a specified time during the loan term. This conversion feature provides borrowers with flexibility and the potential to lock in a fixed rate if interest rates rise. While some ARMs may have shorter initial fixed rate periods, the convertible aspect specifically refers to switching to a fixed rate, not a shorter loan term. Question 133. If a counteroffer has been made, then A. The original offer is terminated. B. The original offer has been modified. C. The offeree becomes the offeror. D. Both A and C. Correct answer is D. Both A and C. While the counteroffer changes the terms of the negotiation, it doesn't modify the original offer. When a counteroffer is made, it effectively rejects the original offer. The original offer is no longer valid. In a counteroffer, the person who was originally the offeree, the one receiving the offer, now becomes the offerer, the one making a new offer. They are proposing new terms. Question 134. The California Standardized Purchase Agreement form gives buyers this much time to either remove appraisal and loan contingencies stated in the agreement or cancel it. A. 15 days. B. 21 days. C. 1 month. D. 3 months. Correct answer is B. 21 days. The California Residential Purchase Agreement, RPACA, typically provides buyers with 21 days to remove appraisal and loan contingencies or to cancel the agreement if those contingencies cannot be met. While this can be modified by agreement, 21 days is the standard time frame in the form. At the end of the default period of 21 days, unless a different time period is specifically agreed to, the buyer either lifts the loan and appraisal contingencies from the agreement or cancels it. Not until the buyer lifts these contingencies can their deposit be forfeited. Thus, a buyer has no money at risk until this occurs. Question 135. In a suit brought by one broker against another regarding a disputed commission split, the plaintiff will not be required to produce a written agreement regarding the commission because A. All real estate contracts can be oral and still be binding. B. The regulations of the real estate commissioner exempt commission splits from being in writing. C. Judges know that commission splits are commonly arranged between brokers. D. By law, commission splits do not have to be in writing to be enforceable. Correct answer is D. By law, commission splits do not have to be in writing to be enforceable. The statute of frauds, the legal authority for which kinds of contracts must be in writing, does not include commission splits. While it's always best practice to have a written agreement regarding commission splits, they are generally not required to be in writing to be enforceable. Therefore, a plaintiff broker in a dispute would not be required to produce a written agreement. Question 136. If the value of the land is $350,000, the cost of building a home on the land is $300,000, and the accrued depreciation is $45,000. How much is the property worth using the cost approach to appraising? A. $500,000. B. $45,000. C. $605,000. D. $5,000. Correct answer is C. $605,000. Here's how to calculate it using the cost approach. Land value plus replacement cost. Accrued depreciation = property value. Land value, $350,000. Replacement cost, building cost, $300,000. Accrued depreciation, $45,000. Calculation: $350,000 plus $300,000, $45,000 = $605,000. In real estate appraisal, accrued depreciation refers to the total loss in value of a property's improvements, like buildings, from the time they were built until the date of the appraisal. It represents the difference between the cost of replacing the improvements new and their current worth. Accrued depreciation is a key factor in the cost approach to appraisal. Appraisers estimate the cost of replacing the improvements new and then subtract the accrued depreciation to arrive at the current value of those improvements. Essentially, accrued depreciation helps appraisers determine how much a building has lost in value due to age, wear, and other factors. Question 137. A purchaser using a Calvet loan finances the transaction with an A. Trust deed, B. Mortgage, C. Contract of sale, D. Option lease. Correct answer is C. Contract of sale. Calvet loans, California Veterans Farm and Home Purchase Program, are unique in that they use a contract of sale, also known as a land contract or installment contract, rather than a traditional mortgage or trust deed. Under a Calvet contract of sale, the California Department of Veterans Affairs purchases the property. The veteran makes payments to Calvet. Calvet holds legal title to the property until the loan is paid off. The veteran holds equitable title and possesses the property. Question 138. Real estate loans are mainly funded by the secondary market, B. Mutual funds, C. Federal programs, D. Bank deposits. Correct answer is D. Bank deposits. The secondary market plays a crucial role in buying and selling existing mortgages, providing liquidity to lenders. However, it's not the primary source of the initial funding for the loans themselves. While mutual funds may invest in mortgage-backed securities, they are not the main source of direct real estate loan funding. While federal programs like FHA and VA guarantee or insure certain loans, they don't directly fund the majority of real estate loans. They encourage lending by reducing risk for the primary lenders. Bank deposits. Commercial banks, savings and loan associations, and credit unions primarily use funds deposited by their customers to make real estate loans. This is the traditional and most common source of funding for these loans. Question 139. A deposit receipt includes the following: A. Executory clause, B. Acceleration clause, C. Release clause, D. Due on sale clause. Correct answer is A. Executory clause. B. Acceleration clause is a provision in a mortgage or loan agreement that allows the lender to demand immediate payment of the entire loan balance if the borrower defaults. C. Release clause is a provision in a mortgage that allows for the release of a portion of the property from the mortgage lien when a certain amount of the loan is paid off. D. Due on sale clause is a provision in a mortgage that allows the lender to demand immediate payment of the entire loan balance if the property is sold or transferred. These clauses are found in mortgage or deed of trust documents, not typically in a deposit receipt. Deposit receipt is a document used in real estate transactions that acknowledges receipt of a deposit and outlines the basic terms of the sale. It's a preliminary agreement that leads to the more formal purchase agreement. A contract is considered executory when one or both parties have not yet completed their obligations. A deposit receipt is an executory contract, A, because it outlines the actions that both the buyer and seller need to take to complete the sale. Question 140. The following is true for brokers holding net listings except A. Other brokers cannot sell the listing. B. The seller receives a predetermined amount from any sale of the listed property, while the broker gets the excess. C. The broker has the right to purchase the listed property. D. Both A and C. Correct answer is C. The broker has the right to purchase the listed property. A net listing is an agreement where the seller specifies a net amount they want to receive from the sale of their property and the broker keeps any amount exceeding that net amount as their commission. Net listings create a potential conflict of interest because the broker's commission is directly tied to the selling price. This can incentivize the broker to prioritize their own financial gain over the seller's best interests. One of the ways this conflict can manifest is if the broker decides to purchase the property themselves. This allows them to potentially profit from any increase in value after the purchase. Because of these potential conflicts, net listings are often subject to strict disclosure requirements. State law requires that within 1 month of the closing of a net listing transaction, the broker must disclose the actual selling price in writing to both the seller and the buyer. Therefore, the statement that is not true about brokers holding net listings is that the broker has the right to purchase the listed property, or more accurately, that this is a conflict of interest that is heavily regulated.